Having been trading for 12 months, Chaining Gear now has a chance to assess the health and the performance of the business. To do so, we're going to use ratio calculations. The calculations cover different aspects of the business, from profitability, efficiency, liquidity, financial gearing, and finally, investment. It assumes in this income statement that the 12 months trading has generated £267,000 worth of sales for Chaining Gear. The cost of sales were £149,520, and the gross profit was £117,480. After various administration costs, we have an operating profit of £8,693, and after overdraft interest, finance costs, we have profit before tax of 5,693. In our next step, when we look at the ratios, we'll take an extract of this income statement to calculate the ratios. Next, we have the statement of financial position as at March 2015, and there we have the various results for the business, including a £30,000 loan, share capital invested in the business, and retained earnings 5,693. Again, we're going to use these core numbers to calculate our ratios as we move forward. Starting with return on capital employed, this is the first of our profitability ratios for Chaining Gear, and you'll notice that it's operating profit divided by capital employed. In this case, that's £8,693 operating profit, and here we have the extract for the income statement here on the right hand side. So the operating profit is 8,693, and the capital employed, the 55,693, is our borrowings, our debt, plus our equity, which includes our retained earnings. So we have 30,000 borrowings and 25,693 of equity, gives us our figure of 55,693 for capital employed. When we multiply the result of this by 100, we get 15.6%. And this will effectively measure how well the business is using the net assets to generate profit. Next, we have our profit margin, which is operating profit divided by our sales. So as we see, our operating profit again is 8,693, and the sales figure straight from our income statement is £267,000, again multiplied by 100 will give us a percentage of 3.3%. Next, we're looking at gross margin, which is gross profit divided by our sales figure, and we see our gross profit here is 117,480, and again divided by the sales figure. We multiply this result by 100 to get 44% for the gross margin. Next, we're going to look at liquidity, and the first of these ratios is the current ratio, which is our current assets divided by our current liabilities. In this case, our current assets, 55,824, as we see here, comes straight from our statement of financial position, and our current liabilities are 17,643. If we divide one number by the other, we get 3.16, which says that our current assets are 3 times greater than our liabilities. So it appears that we could meet our short-term liabilities. Next, we're going to look at our quick ratio, which is similar to the current ratio, except we exclude stock or inventory. So as we see here, the stock is £23,560. We actually deduct that from our current asset figure, and then divide this by the current liabilities, which is 17,643, which gives us the figures 1.83. Next, we're going to look at what we call efficiency. And we're looking at inventory or stock turnover. We have inventory divided by our cost of sales. Well, our inventory figure is 23,560 and our cost of sales is 149,520 pounds. So as we can see from our income statement. And this time we multiply the result of those two numbers by 365 days to get the number of days for our inventory turnover, which is 58 days. We carry out the same process for our receivables and our payables and extract those figures from both the balance sheet and the income statement. So we have our receivables, our sales for the receivables collection, and then trade payables and cost of sales for our payables payment period. Similar process to our inventory turnover. The net effect of our inventory, receivables and payables is what we call our cash collection cycle, which in this case is 47 days, which is the 58 days for the inventory turnover plus the receivables less the payables payment periods to give us our cash collection cycle. Effectively, we're looking for the smallest possible figure here to get our cash in to the business. Next, we're going to look at our financial risk, and we're looking here at our interest cover. So we have operating profit divided by interest. So as we've seen our earlier ratios, the operating profit is 8693 and then the interest is £3,000, which again we can get from our income statement up the top here. And on the face of it, it looks like we're in quite a healthy position here. We've got something like almost 3 times the interest payable is covered by the profit, and therefore there doesn't seem to be a high level of financial risk at this point in time. Next, we're going to look at gearing, and this is effectively as our debt compared to our equity in the business, and we can pick up our debt figure from the statement of financial position and equally the equity and the debt figure from there. So if we look across to the statement of financial position, there's our debt or borrowings of £30,000, and then we have our equity, which is 25,693. So to get our gearing ratio, we put our debt, divide this by the debt plus equity, and multiply that by 100 to give us 53.9%. And finally, we're going to look at our earnings per share, an investment ratio or shareholder ratio, and this will simply be our net profit divided by the number of shares in issue for the business to give us 57 pence per share. As we can see here, we have the profit before tax of 5693 and the shares in issue were 10,000 shares. So to recap, we have a range of ratios we can examine to look at the health and performance of the business, and most of the ratios will come from our 2 main statements, either the income statement or the statement of financial position. That is profitability, efficiency, liquidity, gearing, financial gearing, and investment. It should be noted here that we've only used 1 year's worth of transactions as Chain & Gear as a startup business. Ideally, we'd have at least 2 years, possibly even 3 years, so we can make a really sensible assessment of how the business is comparing from 1 year to the next. Furthermore, it would also be useful if we could compare Chain & Gear to other bicycle retailers to really get a sense of how good the business is performing.